Hey guys, Japan Market Samurai here. Wait, you're not seriously thinking Japan's already gone too high? It's too late to invest, right? You're not still comparing this market to 1989, are you? Because while you hesitate, the smart money is already positioning for the next 25 years. What if this video alone could open your eyes to the single most undervalued, overlooked opportunity in global markets right now? And what if that opportunity was Japan? You might think, well, understanding macro trends like this is only for hedge fund managers or professional investors. But the truth is, it's not about having a special talent. It's about seeing what the data actually says and how to interpret market structure over market noise. And that's exactly what I'll show you, in a way that anyone can understand and act on. Imagine this. You're holding Japanese equities that compound quietly at 10-12% a year. You're not glued to charts, not chasing volatility, not sweating every rate hike in the US. Instead, you're riding a decades-long transformation where governance, earnings, capital inflows, and geopolitical positioning all align. You sleep well at night, knowing your portfolio is exposed to the only developed market that's still fundamentally undervalued. Let me guess, you've probably thought, Japan? Isn't that the country with an aging population, deflation, and zero growth? You're not wrong. That used to be true. But what if I told you that mindset is now your biggest liability? Because Japan has changed, but the global narrative hasn't caught up. And if you keep clinging to yesterday's image of Japan, you're going to miss the biggest shift in Asia since China's WTO entry. This isn't for everyone. If you're comfortable playing the same short-term game as everyone else, feel free to click away. But if you want to own the narrative before the world wakes up, then keep watching. But I don't understand Japan. I don't follow foreign markets. I missed the run-up. I'll wait for a dip. Stop. Those aren't reasons. Those are excuses, wrapped in fear. You don't need to time the bottom. You need to understand the structure. And right now, that structure says Japan is just getting started. Not long ago, Japan was considered a lost cause. Investors laughed. Funds ignored it. The West moved on, but while the world looked away, something extraordinary happened. Governance transformed, buybacks exploded, earnings hit record highs. Now, Japan's becoming a global capital magnet again, but only those paying attention will benefit. You missed Nvidia at $30. You missed Tesla at $50. Are you really going to miss Japan at 1.5x PBR? Everything I'm about to share is based on first-hand research, primary data, and macroeconomic insight, not just hype or headlines. This isn't your typical Japan is cheap video. This is a complete reframe of how to view Japan as a revaluation asset. If you've ever felt like you were one step behind global trends, this is your moment to flip that script. So don't blink, don't click away. Let's break down why Nikkei 50,000 is just the beginning, and why 1,000 by 2050 is not only possible, but mathematically likely. Step 3. This is not a bubble. It's a revaluation. Conclusion. The Nikkei's rise is fundamentally sound. The Nikkei crossing 50,000 is not a sign of irrational exuberance. It's not a bubble, it's a long overdue revaluation of Japanese equities. The current rally is supported by strong earnings, disciplined valuations, and structural reforms. While many are still stuck comparing today to 1989, the truth is, this time is different, and the numbers prove it. Recent valuation metrics tell a completely different story. Back in 1989, Japan was the epitome of a bubble economy. Price-to-earnings ratios hit the 50x range. Price-to-book ratios, PBR, were over 5x, and corporate profits couldn't justify any of it. Fast forward to today, and the story has completely flipped. Current PER levels hover around 20 to 22, much closer to global averages. PBR, many companies in Japan still trade below 1.0x, meaning the market is valuing them less than their net assets, something unheard of in most developed economies. On top of that, Japanese corporate earnings are at all-time highs. These aren't speculative surges. These are price movements driven by record profits, strong balance sheets, and long-term policy tailwinds. In other words, while the headlines scream market peak, the underlying data whispers just getting started. Example comparing 1989 to 2024. Side by side. Let's break it down side by side. 1989. Nikkei was at 38,957. PER Q5er. PBR Q50x. Corporate profits stagnant. Narrative hype. Land speculation. Inflated assets. 2024. Nikkei above 50,000. PER 2022x. PBR under 1.5x. With many companies under 1.0x. Corporate profits historic highs. Narrative, increased ROE, stronger governance, policy-backed reforms. Back then, investors were buying dreams. Today, they're buying undervalued businesses with solid fundamentals. Take companies like Toyota, Hitachi, or Mitsubishi UFJ, all trading at reasonable multiples with generous dividend policies and steady growth. These are not moonshots. These are cash-generating, world-class enterprises that just happen to be located in the world's most misunderstood market. Summary, why this is only the beginning. So, here's the bottom line. This market is not flying on hype. It's being lifted by earnings, efficiency, and equity reform. The comparison to 1989 is not just inaccurate, it's dangerous. It blinds investors from seeing what's really happening. Japan's stock market is undergoing a structural revaluation, and 50,000 isn't the end of the line. It's the beginning of a long-term upward trajectory. Those who understand this now will be positioned for a compounding opportunity in what is arguably the most undervalued developed market on the planet. Step 2. Corporate Japan has fundamentally changed. Conclusion. Japan is now a shareholder-friendly economy. If you still think Japan is a conservative, cash-hoarding market that neglects its shareholders, you're looking at a version of Japan that no longer exists. Over the past decade, Japan has transformed itself into a capital-efficient, globally competitive, shareholder-focused economy. Corporate governance reforms, Tokyo Stock Exchange initiatives, and structural pressure from both domestic and foreign investors have completely reshaped how Japanese companies operate. This is not just a policy shift, it's a cultural shift, and it's one of the most powerful reasons Japan's market is finally gaining momentum. Reason the governance revolution is real and measurable? Since 2015, when Japan implemented its corporate governance code, companies have faced growing pressure to improve return on equity (ROE), increase transparency, and prioritize shareholder returns. That pressure became visible in 2023 when the Tokyo Stock Exchange began naming and publicly urging companies with price-to-book ratios below 1.0 to improve capital efficiency. For the first time in modern history, Japanese management teams were being held accountable, not just by activist funds, but by their own domestic institutions and regulators. The result? Massive growth in share buybacks, rising dividend payout ratios, clear shifts from hoarding cash to deploying capital in ways that enhance shareholder value, and this is only accelerating. Example, buybacks, dividends, and domestic capital flow. Let's talk numbers. In 2024, Japanese firms announced record-breaking levels of share buybacks. Companies like Sony, Toyota, and SoftBank are repurchasing billions in shares, not as a one-off, but as part of an ongoing capital return strategy. Dividends have also reached new highs. Many companies have adopted stable or rising payout policies, moving away from the historically conservative approach of sitting on cash. At the same time, the introduction and permanent establishment of the new NISA system in 2024 created a game-changing dynamic. Japanese individual investors, who had previously parked trillions of yen in low-interest savings, are now moving their capital into the domestic stock market. This is not hot money. It's long-term, tax-advantaged, domestic capital that is here to stay. This flow alone has begun to form the base of a new market structure, where Japanese savings finally power Japanese equities. Summary: the engine of Japanese capitalism has been rewired. In the past, foreign investors avoided Japan because of low ROE, poor governance, and low capital returns. Today, those same investors are re-entering because Japan is fixing all of those issues at once. The TSE reforms were not cosmetic. They are part of a broader ecosystem of accountability, transparency, and capital efficiency that's now taking root across the economy. This means that every company you invest in is operating in a fundamentally better environment than just 5 years ago. And that environment, one of reform, domestic capital flows, and shareholder alignment, is the fuel behind Japan's next long-term market cycle. Step 3. Japan has entered a structural growth phase. Conclusion. Japan is no longer stuck in deflation. One of the most powerful yet underappreciated changes in Japan is this: deflation is over. For decades, Japan was known as the zombie economy. Flat wages, falling prices, and economic stagnation. That era is gone. Today, Japan is entering a new phase of nominal growth, driven by wage increases, pricing power, and sustained internal demand. This shift is not cyclical, it's structural, and it's rewriting everything we thought we knew about Japan's growth potential. Reason wage growth and inflation are finally real. Let's start with wages. In the spring of 2025, Japanese companies implemented average wage increases of 5.25%, marking the third straight year of record-breaking hikes. This is not a one-time stimulus-driven event. It's part of a broader trend, where employers are finally competing for labor, something that hasn't happened in Japan for decades. Why does this matter for investors? Because it means Japanese consumers now have purchasing power, and when people spend, companies can raise prices, boosting revenues and profits. Inflation in Japan, long seen as a negative, has also changed character. The country has entered a sweet spot of 2-3% annual inflation, which is no longer viewed as a threat, but as a growth driver. This good inflation is helping companies scale, adjust pricing, and increase margins, all while wages rise in parallel. It's a healthier, more dynamic economic structure than Japan has seen in over 30 years. Example, real economy indicators confirm the shift. Let's look at what's happening on the ground. Retail spending is up. Large employers are raising pay not just for full-time workers, but also for part-time and contract employees. Consumer confidence indices have rebounded. At the same time, Japan's nominal GDP is expanding steadily, helped by both internal consumption and external drivers like tourism and exports. And speaking of exports, Japan's current account surplus is at historic highs. Why? Because Japanese firms are now earning massive income from overseas investments. These foreign earnings are flowing back into the country in the form of dividends and reinvestments, directly supporting corporate profits. In short, Japan is no longer growing despite deflation. It's growing because inflation and wage expansion are finally working together. Summary: Japan's growth engine has been reignited. This isn't a rebound, it's a regime shift. Wages are rising, consumers are spending, companies have pricing power. And all of this is happening in a stable political environment with long-term policy tailwinds. The narrative of Japan as a stagnant or dead economy is outdated. What we're seeing now is the rise of a new growth model, one that supports sustainable earnings expansion, higher valuations, and long-term equity returns. For investors who recognize this shift, the message is simple. The old Japan is gone. The new Japan is investable. Step 4. Japan is becoming a global supplier again. Conclusion. Japan is reclaiming its role in global manufacturing. Japan is no longer just a country of aging demographics and nostalgic brands. It is rapidly re-emerging as a critical node in the global supply chain, particularly in high-tech, high-value manufacturing. After decades of offshoring and industrial stagnation, production, capital, and talent are now flowing back into Japan. This isn't about bringing back old factories, it's about building the industries of the future on Japanese soil. From semiconductors to advanced robotics, Japan is positioning itself not just as a participant, but as a strategic supplier in a fragmented global economy. Recent global trends are reshoring production to Japan. The world is shifting. Geopolitical tensions, supply chain disruptions, and the fragility exposed by COVID-19 have made countries rethink their manufacturing dependencies. Japan is uniquely positioned to benefit. It offers political stability, advanced technology, deep talent pools, and proximity to key Asian markets, all while avoiding the systemic risk of authoritarian regimes. In response, governments and private corporations have begun rebuilding domestic production capacity within Japan. And this time, it's not just to protect jobs, it's to secure national resilience in critical technologies. From a macroeconomic standpoint, this industrial resurgence creates long-term demand for labor, infrastructure, innovation, and investment, all of which feed directly into GDP and corporate earnings. Example, TSMC, Rapidus, and the manufacturing supercycle. Let's talk about the most visible signs of this shift. In 2024, TSMC's Kumamoto plant in Japan officially went live, a massive statement by the world's leading semiconductor manufacturer. Construction of a second facility is already underway. Meanwhile, Rapidus, a Japanese semiconductor consortium backed by both the government and private sector, is investing billions into next-generation 2nm chip fabrication, a space dominated by just a handful of global players. These aren't isolated events, they are part of a 10-15-year supercycle, where capital expenditure, government support, and private innovation align. We're also seeing massive investments in EV components, robotics, aerospace-grade materials, and automation systems, areas where Japan has long held technological advantages and is now scaling production to meet global demand. Add to that the return of domestic R&D, job creation, and a renewed focus on supply chain localization, and you get a picture of an economy that's not just adapting, but leading. Summary: Japan's industrial rebirth is the final piece of the puzzle. For years, Japan was considered a post-industrial nation, too mature, too slow, too stuck in the past. But those assumptions are now being shattered. Japan is once again becoming a builder of what the world needs most: secure, scalable, and strategic technologies. This shift ties together everything we've talked about: rising earnings, strong governance, domestic capital inflows, nominal growth, and now, the final catalyst, industrial revival on a global stage. For long-term investors, this completes the investment thesis. Japan is no longer just an undervalued market. It's a structurally sound, innovation-driven, globally essential economy with decades of runway ahead. Message: empowering the audience with vision and confidence. If you've made it this far, then you're no ordinary investor. You're someone who sees beyond headlines, beyond short-term fear, and into the heart of what drives real value. Japan is no longer the ghost of its past, it's the quiet engine of the future. While the world obsesses over hype cycles, you're now equipped with the knowledge to ride a trend that is backed by numbers, structure, and time. And here's the truth: timing the market is luck, understanding the structure is skill. And right now, that structure is screaming opportunity in Japan. You don't need to be a genius. You just need to act while the rest of the world is still asleep. Channel subscription and community engagement. This channel delivers premium level insight based on primary data, first-hand analysis, and structural macro thinking. If you found value in today's content, smash that like button and subscribe if you haven't already. Most people watch once and move on, but real growth comes from repetition and reflection. So I encourage you to rewatch this video and dive into our other content. You'll pick up deeper layers each time. If you have thoughts, questions, or topics you want covered, drop a comment below. I read everything, and your input helps shape future videos. Recap: reinforce key takeaways for memory and motivation. Let's quickly recap what we've covered. Japan's market is not a bubble, it's a revaluation. Corporate governance has radically improved, making Japan shareholder-friendly. The deflation era is over. Nominal growth and rising wages are now structural. Japan is reindustrializing to become a global supplier of critical technologies. Together, these trends make Japan the most underappreciated yet promising developed market today. Gratitude and anticipation. Thanks for watching till the end. That alone puts you ahead of 95% of investors. This is Japan Market Samurai, and I'll see you in the next video. Until then, stay sharp, stay curious, and always invest with conviction.